Want to grow your money without checking the stock market every single day? Maybe you feel like investing is too complicated or takes too much time. What if I told you there's a way to participate in the market's growth with minimal effort? Then let me introduce you to index funds. They could be your new best friend in wealth building, especially if you're just starting out or prefer a hands-off approach. Okay, let's break it down simply. An index fund is like a giant basket holding a little piece of many different companies. Instead of trying to pick individual winning stocks, an index fund invests in a whole group of stocks that represent a specific market index. Think of famous indexes like the S&P 500, which tracks the 500 largest U.S. companies, or the NASDAQ, which focuses on technology stocks. When you buy a share of an S&P 500 index fund, you instantly own a tiny slice of every major company in that index. It's instant diversification without the hassle. So, why is this strategy so powerful, especially for long-term wealth? Because over time, despite short-term ups and downs, the overall stock market has consistently gone up. Index funds are designed to simply ride that wave. They don't try to time the market or make fancy trades. They just track the performance of the index. This simple, consistent approach has actually allowed index funds to beat the performance of most actively managed funds run by professional investors over the last 30 years. It's proof that sometimes the simplest strategy is the most effective. The advantages of index funds are pretty compelling, especially for beginners or those who prefer a passive approach. First, they typically have very low fees compared to actively managed funds. This means more of your money stays invested and working for you. Second, as we mentioned, they offer instant diversification, spreading your risk across many companies. You're not putting all your eggs in one basket. Finally, they are the ultimate set-it-and-forget-it investment. You invest regularly, and you let the market do the work over decades. It's truly the lazy genius way to build wealth steadily. Even legendary investor Warren Buffett has famously advised people to put their inheritance into low-cost S&P 500 index funds. Getting started with index funds is much easier than you might think. You don't need a lot of money to begin. Many brokerage platforms allow you to start investing with as little as $50 or $100. Popular and reputable platforms like Fidelity, Schwab, or Vanguard are great places to open an investment account. Once you have an account, you can look for specific index funds or ETFs, exchange-traded funds which are similar, that track broad market indexes. Common examples include funds with tickers like VTI, which tracks the total U.S. stock market, VOO or FXAIX, which track the S&P 500. The key is not to overthink it. Choose a broad market index fund, set up automatic contributions if you can, and just start. Consistency over time is what matters most. Index funds might not be the flashiest investment out there. They don't promise overnight riches or exciting daily trades, but for building long-term wealth, especially for retirement or other big goals, they are incredibly effective and simple. They win the race through consistency and low costs. If this helped you understand index funds better, please give us a thumbs up by hitting that like button. Share this video with anyone else who wants to start investing the smart, simple way. And don't forget to subscribe to Money Fix Daily for more tips on growing your money. Let's build wealth together the easy way.